Today, we're diving into the fiscal fourth quarter 2025 earnings from 1-800-Flowers.com. And let me tell you, this was not just another report. It was a real story of some deep challenges, a brand new CEO with a very bold plan, and a stock that took investors on an absolute roller coaster. So let's get right into it.
So, right off the bat, the quarter presented this major conflict. On one side, hey, the company actually managed to beat revenue expectations, which you always like to see. But on the other side, it posted a really significant miss on earnings per share. That signals some deep trouble with profitability. This tension, between the top line and the bottom line, is really what set the stage for the entire day.
So let's start by digging into the exact numbers that drove the market's reaction. This is the what that happened. Then we'll get to the so what, the company's new game plan.
The details here really tell the story. Revenue, it came in at about $336.6 million, which beat the consensus by a pretty solid margin. But the profitability metrics, well, that's a completely different story. The non-GAAP EPS loss was 69 cents, much worse than the 51 cents Wall Street was expecting. And the adjusted EBITDA loss, it more than doubled from last year. The key takeaway is pretty simple. They were bringing in sales, sure, but they weren't profitable sales.
And this pressure on the top line was felt everywhere. This wasn't an issue with just one part of the business. The main floral and gifts segment, that was down almost 9%. Gourmet foods fell over 3%. And even their business-to-business BloomNet segment saw a little dip. So yeah, the weakness was truly broad-based.
And here it is. This is the heart of the profitability problem boiled down to one number, a 290 basis point drop in gross margin. That's a 2.9% decline. Management pointed to a highly promotional environment, basically lots of discounts, and sales deleveraging. That's just a fancy way of saying their fixed costs got spread over fewer sales. This margin compression, that's the financial wound they have to heal, and fast.
So, with that kind of bleak financial picture established, the whole focus of the earnings call shifted to the new CEO, Adolfo Villagomez, who had just stepped in a few months ago. This is where we moved from the problem to the proposed solution, a complete strategic reset.
Villagomez laid out a 4-pillar celebration strategy to fix things. In essence, it's this: get lean through cost savings, get smarter with a renewed customer focus, get bigger by expanding into new channels, and get better by building a real culture of accountability. It's a pretty comprehensive playbook for a turnaround.
Okay, now you really want to pay close attention to this quote, because it's probably the most important strategic shift they announced on the whole call. The company basically admitted that in the past, they were just chasing unprofitable sales. They were spending more to get a customer than the profit that customer was actually generating. This pivot to variable contribution margin is a promise to stop doing that.
So, what on earth is variable contribution margin? Let's make it simple. Think of it this way. For every dollar in sales, after you subtract the direct costs of making and selling that item, what's left over? That remainder is the contribution margin. By focusing on this, the new strategy ensures every single marketing dollar is spent to generate actual profit to help cover fixed costs, not just empty revenue.
This new plan isn't just happening in a vacuum. It's a direct response to a whole list of failures from the past year that they owned up to. Inefficient marketing, problems with their order management system, a bloated cost structure. The new strategy is literally designed to tackle each one of these head-on.
Okay, so a bad quarter was followed by a promising new plan. How did the market react to this mix of news? Let's take a look at the verdict.
The stock's journey on earnings day tells the whole story. The initial release at 6:45 in the morning caused a bit of a panic. The stock plunged around 10% before the market even opened. But as the day went on and investors really started to digest the CEO's turnaround plan on the call, the stock clawed back most of its losses, closing down less than 3%. This suggests there was initial shock, followed by a sort of grudging respect for the new vision. But let's put this all in context, because the stakes are incredibly high. Over the past year, while the broader retail ETF, XRT, was up over 16%, 1-800-Flowers was down nearly 30%. This massive underperformance really highlights just how crucial this turnaround is for investors.
Ultimately, the market heard the new CEO's plan, and it was enough to prevent a total collapse. But after a year of underperformance and operational missteps, investors are firmly in a show-me state of mind. They want to see proof of execution, not just more promises.
All right, that brings us to our final segment. We've diagnosed the problem, we've analyzed the new strategy, and we've tried to read the market's tea leaves. Now let's put all this together into a forward-looking thesis.
Management has called fiscal 2026 a pivotal foundation-setting year. So, for investors, the central question is, how do you position yourself for what's coming next?
For this stock to get re-rated higher, investors are going to be watching for very specific catalysts. Can they execute cleanly through the crucial holiday season? Do we see that gross margin number start to tick back up quarter after quarter? Can they show some meaningful growth from new channels like their Uber Eats partnership? These are the kinds of milestones that will prove the strategy is actually working.
So here's our takeaway. We're assigning a market perform rating. For the next quarter, the focus should not be on revenue growth, but on stabilizing those bleeding margins. We expect the stock to probably be range-bound until some tangible proof of this turnaround appears. It's a classic show-me story, where the potential reward is high, but it's balanced by some very significant execution risk.
And of course, we always have to end with a final reminder. This is not financial advice.